Hi, this is Kelly Wright at the Money Show in Dallas, and joining me today is Mr. Landon Whaley of Whaley Capital. Landon, we're talking off camera, and you broached a couple subjects that are near and dear to my heart. One of them is reversion to the mean.
Right.
I happen to be a big believer in that past history is going to be repeated to some extent.
Okay.
Also, that we had a really unusual generational thing happen in this country called quantitative easing that created one of the biggest boons in the stock market history.
No question.
We've got an entire generation of investors, if you want to call them that, who think that that's going to be that way forever. Okay?
Yep.
Let's help them understand why they're wrong.
Sure, absolutely. Well, look, it's not just the fact that there is a generation or a big chunk of a generation of investors who've known no other market.
Right.
More importantly, to the systemic risk question, we got a whole generation of professional asset managers.
Correct.
People in professional roles on Wall Street, foreign banks,
right,
that started within the last decade, who've only known one kind of market,
right,
which, as you point out, was lubed by not just Fed easing,
right,
but globally synchronized easing by every major central bank on earth.
Correct.
Which provided the most conducive environment for equities and risk assets, frankly, unlike the world has ever seen at one time, in all places.
You didn't have to be smart, you just had to be in.
That's right. And again, I'm a global macro guy and a market historian of sorts. So I can speak, I think, fairly confidently on the fact that not just in the U.S. the last 10 years, but in Australia, Asia, both
Europe,
emerging as well as developed, Eurozone, Latin America, all over the world, it was easy money and a lot of easy trades.
Sure.
And again, a lot of outsized returns for markets, that again at average, let's say high single digits, low double digits, all those returns got pushed higher by zero bound interest rates, lots of liquidity,
correct,
those types of things.
Now, you used a phrase which really piqued my interest in what was stealing from the future.
Sure. So, the basis is this. If a market, and if it's a bond, commodity, equity market, currency market, averages, let's say, 7% a year for some long period of time,
let's say 50 years.
Okay, 50 years, that's fine. Well, this repeatedly happens where markets go on tears. Right? Both up and down.
Correct.
So let's talk about the upside. If you've got a market that's averaged 7% a year for 50 years, and then all of a sudden it goes through a 5 to 8 year stretch where it's clipping 12, 13, 14, 15% a year, in my humble opinion, you are simply stealing from the future. You are pulling returns from the future to you currently. Okay. You're not, there's no new dynamic, okay, that takes place. So what that means is, at some point, we revert to the mean. And what that looks like is a couple of different things. Either you get a big sell-off, right, a 30, 40, 50% decline, and then it sort of meanders its way back up, and over a 5-6 year stretch, you get back to that 7% return.
Okay. Or
you muddle through, +3, -3 types of returns for 6, 7, 8 years or longer. So, but either way, you're getting back to that 7%.
Okay, right? So this is great. This is kind of a particular topic of interest to me because from 1929 to 1995, it's a fairly long stretch of history. The Dow Jones Industrial Average traded between dividend yield extremes of 3% and 6%. Okay. Then in 1995, the market completely lost its mind. And for the first time in history, it eclipsed the 3% yield and went to 1.5%.
Right. And stayed there.
Until March of 2009.
That's correct.
Where we had this little sell-off, okay? My contention is that was a period of equilibrium, 1929 to 1995, and that eventually the markets will recalibrate. Okay? Does that make sense to you?
No question. Okay. No question. And someone much smarter than me once said, history doesn't repeat, but it often rhymes.
Rhymes, sure.
That's absolutely true. And you can't. Boy, our humanness. I refer a lot to our clients and when I speak publicly about humanness, because I believe it's the one factor that helps level the playing field and skew the odds of success in our favor. Our humanness is we anchor to things. We the way people forecast, and when I say people, I mean individual investors as well as professionals like central banks, sovereign wealth funds, Wall Street guys. they simply, when they go to forecast something, they simply look at what's happened recently, the last 6 months, 12 months,
near-term bias,
and just extrapolate it forever into the future,
yes.
Good or bad,
yes.
right? If we're in the midst of a recession, it's always, everything's going to zero, and if we're in the midst of what we are now, which is a 27-month growth accelerating phase here in the U.S. where everything has gone up, that's going to continue on forever as well.
Of course.
And the reality is markets and economies cycle, and they cycle right when you think they wouldn't. And catching a lot of people off guard, and so it's that speaks right to that point.
Well, I've said forever that Mr. Market's primary job is to perform a walletectomy on as many people as he can.
No question. There's no question.
When they least expect it.
No
All right, we'll have to catch up on this and some more. This is Landon Whaley. I'm Kelly Wright. We're at the Money Show in Dallas. Thanks for joining us.